Hi, everyone. Jim Kruzan here for the third quarter market and economic update. Hope everybody's doing well. Hope everybody had a wonderful summer. Some of this information, all the slides are updated, but a lot of the information is going to sound somewhat similar because in spite of a lot of volatility and markets that seem to be just roaring ahead, a lot of the underlying economic data still looks very weak. And as a result, we're maintaining a pretty defensive position, especially with large retirement accounts. As we've said many times now, there are three economic outcomes, really two, and then this other broadening effect. One is the data will lead to a recession, in which case the data continues to weaken until we finally see a drop. This is also, by the way, how most recessions occur. Everything looks great. By the time the recession happens, everybody has discounted the fact that it'll never happen, and it comes as a big surprise. Or we could see a soft landing, in which case data should continue to improve. And we're really not seeing a lot of that. The other thing that could happen, I guess, under both scenarios is a market broadening out. We alluded to this the last time we met, and actually we're beginning to see a broadening out of the market. We don't know whether that's like the last stage of the bull market, people buying in because they're tired of sitting and waiting, or whether it's something different. But as you'll see in a few moments, the mega cap stocks, which still control a lot of the growth year to date, and certainly over the course of the last 2 years, is giving way now to some other positions, other areas of the economy. If we look at the leading economic index, which was reported out just about 2 weeks ago, it dropped again. It dropped another 0.2% and has continued to drop now for something like the last 27 months or so. Generally, when you see these drops, it usually leads to a recession without exception. The only soft landing we've had is 1997. And when you look on the chart and consider the drop we've had in LEI relative to the drop we've had today, it's really hard to kind of square those circles. The yield curve reverted, so it's a little bit uptrending now. And while that sounds good that an inverted yield curve has rewrited itself, as you'll see in a moment, recessions usually occur not at the time of the inversion, but at the time that it returns to normal as the Fed starts pushing down interest rates, which we began to see as well. But you'll certainly see the chart both from 2 years ago, last year, and current, which is blue, much flatter than it's been the last several sessions. This shows the long-term effect of an inverted yield curve going all the way back to 1960. The blue line measures the yield spread, the difference between a 10-year bond and a 1-year bond. If it's a normal, healthy, ascending yield curve, the 10-year rates are higher than the 1-year rate. So it's a positive spread. A positive spread is reflected in the blue line as it sits above the red line, which is zero. Anytime the blue line is below or underneath the red line, that's an inverted situation. And you'll see in just about every case, not just about, in every case, the inverted yield curve yielded a recession. And it didn't happen at the time of inversion, but as the yield curve started to normalize. The other thing that we've been watching for a while, and this quarter it actually triggered, was the SOM rule, which measures the rate of increase in the unemployment rate. The unemployment rate is a lagging indicator. It is not predictive of anything, but the rate of change, the rate of increase can be. And as predicted by the SOM rule, it does indicate upcoming recessions. The spread between the most recent last three unemployment rates, the average, compared to the lowest rate within the last 12 months, once that spread gets above 0.5%, we're right on the cusp of a recession. We trigger that in July, and it's still above that number. And you'll see by the chart, gray bars representing recessions, Anytime the SOM spread, that blue line, gets above about 0.5%, the difference between 0 and 1%, it's usually right on the outer edge of that gray bar, which identifies recession. All three of these are independent. All three of these certainly suggest caution. And as a result, we're taking a cautionary tact with respect to those meaningful portfolios. In addition to all that, I'm not going to read through all these. There's been a lot of economic data the last 30 to 60 days. A couple that are noteworthy: credit card delinquencies, those identified as late, 90 days or more. This is through June 30th, almost 11%. And in fact, just a year ago, that number was about 8%. So that's nearly a 40% increase in the last 12 months. Buy now, pay later is also really high. Manufacturing, both the PMI and new factory orders, are still in recessionary periods of time. The initial jobs claims spiked and increased. And by the way, today we had initial job claims again, and they were 30,000 more than anticipated. And the total number of individuals that are on claim was higher than expected as well. So there is some weakness in labor, in spite of the fact that new employment reports are really wonky. They're hit or miss. They outperformed last month. They revised down nearly 1 million jobs that were stated, which in effect were not really new jobs. So it's really a little difficult to identify. I talked about the LEI a while ago. And as of just recently, the LEI, again, as I said, dropped. It now marks the 6th consecutive monthly decline. There have been, I think, 26 of 27 declines. And this is now triggering a recession signal. So again, it's been a long time coming. Not saying it's here immediately, but it's really hard to just be Pollyanna and be quite aggressive with a lot of this data being the way it is. And being the way it is, and we haven't seen it this way in 15 plus years. So caution certainly rules the day. As far as performance, you'll see the returns here per quarter on some of the major indices and year to date. Obviously, big tech, NASDAQ is pushing and continues to contribute to the S&P's performance. And the S&P's performance is vastly superior to the Dow Jones. The other thing to consider is bonds are still flattish on the year, with the aggregate barely up at all and long-term treasuries actually slightly down through September 30th. So a balanced account, part stock, part bond, is really mid-single digits in spite of the spectacular return on the S&P. For the month, the S&P really somewhat underperformed its longer-term average. And that's quite interesting, since in that period, we also had the Fed reverse pivot and cut rates 0.5%. So the market returned a bit, but when you see the overall monthly return, it's somewhat benign, meaning that the market was starting to correct back, pull back before that Fed meeting. And one last thing about the market, the Mag 7. I've reported out several times now how concentrated this market has been, how the Magnificent Seven has really contributed almost all the return of the S&P 500. And I mentioned, I believe it was in July, we're beginning to see the market broaden out a little bit. Here we are now for the full quarter, third quarter of the year, and we're really beginning to see that. I showed the returns for the quarter: Microsoft, Apple, Google, Amazon, NVIDIA, Meta, Tesla, and the weighting that those individual stocks hold within the S&P and the weighted return. That said, those seven contributed about 0.75% of the return to the S&P. With the S&P up a little over 5%, its contribution was just under 14%. The last quarter, it was well over 100%. And the first quarter, it was well over 100%. So we're beginning to see a little bit of broadening out. Those big tech stocks are beginning to pull back a bit. I'd like to pivot now, if I could, and just touch on some of the JP Morgan economic slides as they relate to market and market valuation. This is a chart showing the PE, price earnings ratio of the market. And what it's showing is the forward-looking PE with the built-in assumption of earnings growth over the year. The current assumption is next year's earnings are going to be about 12% higher than this year's earnings, in spite of the fact that we're seeing measurable slowdown in the economy. So we can argue whether that really holds up or not. But at 21 and a half times earnings, it's extremely expensive. Not as expensive as it was during the dot-com bubble, but nearly. And when you look at PE or cyclical adjusted PE or dividend yield or price to book or price to cash flow or earnings yield equivalent, they're all effectively showing very high under or overvalue, where they're in many cases 1 to 2 plus standard deviations greater than normal. That's problematic. And where it comes into play is relative value versus return. It's not a guarantee, but generally, when you're dealing with a market that has a PE of 21 times earnings, the forward-looking one-year return of the S&P is really quite low, as you'll see in this first chart to the left. The scattergram shows all the various quarterly PEs that have been calculated over the years, and you'll see kind of the best fit line, and you'll see where it would be with a 21 and a half times earnings. The expected return over 1 year is really quite weak, and the expected return over 5 years is extremely weak as well. Very low single digits. Reason? When you see those kinds of Ps, you're prone to sizable drawdowns or drops. So that takes a lot of the return and return energy kind of out of the market. Another thing I wanted to talk about is this concentration again. It's really quite high. While the Magnificent Seven are contributing less, it's really hard to look at the returns without understanding that they've contributed quite a bit. The top 10 stocks in the S&P represent 35.8, almost 36% of the S&P index. And what's interesting is if you look at, this would be the chart to the right top, and you look at where we are today, 35.8% concentrated among the top 10 stocks. You can go all the way back to the dot-com bubble, year 2000, and it represented about 27%. We're way over our skis in terms of concentration. And here's the Magnificent Seven's performance, the green line relative to the S&P, or relative to the S&P less the Magnificent Seven. Huge skew, dragging the index up, not unlike what we saw back in 1999, 2000, et cetera. They say this market is 70% consumers, and consumers always find a way to spend money. We just talked about default rates on credit cards. We could talk about default rates on autos as well, and other areas as well. We're beginning to see those delinquencies start to rise. If you look at the right-hand side of the page and look at the bottom chart, you'll see flows into early delinquencies. The black line, which is upward trending, not quite, but nearly what it looked like going into the last major recession. Same kind of valuations. We've got the credit card default or delinquencies. The blue line immediately underneath that, again, approximately what we saw leading into 07 and 08 was autos. And then student loans are flat to downward trending. We're in a really funky period of time. All during COVID, students didn't have to make student loans. Everybody started to make payments, or I should say, are required to make payments as of October last year. That said, there was a 1-year moratorium, which basically said, hey, your loan provider will start charging interest, but if you don't make the loan, it's not going to affect your credit. And that was for a 1-year period, ending, I believe, the end of this month, end of October. And guess what? The vast majority of those who are required to make payments aren't. The hope is maybe there will be something that will happen politically, maybe the next election, maybe there'll be a big cancellation. I expect that number to increase quite a bit. And more importantly, when that number does increase, because remember, student loans are the only loan that you can't terminate or set aside in a bankruptcy. So those get made. And if those start getting made, what is it that say for car loans or credit card loans? I suspect those start to ramp up as well. So those are the things we're looking at. Those are the things we are worrying about. As we said before, we're watching this very closely. We're somewhat defensive. Since the market is broadening out, the IRA is beginning to perform. We're up probably 5.5% or more year to date. The important thing is that's actually outperforming money market. So very defensive, performing a little bit better than money market, 3/4 of the way through the year. 3 things will happen: recession, soft landing, or broadening out. And we'll keep you posted. If you have any questions or would like further discussion or more information, reach out to us by phone or reach out by website. And as always, thank you so much for your support and confidence now and through the years. If we can help in any way, please reach out.